Imagine you're watching a science fiction movie where humans exist in a simulated reality, a vast program designed to keep them contained while their energy is harvested. Now imagine that within this system, there's a glitch, a loophole that allows those who understand the code to manipulate the simulation itself. This glitch would be the ultimate advantage, wouldn't it? What if I told you that in our own reality, such a glitch exists? It's called the stock market, a system embedded within our larger economic matrix that allows for the legal transfer of wealth from one hand to another. Let me take you back to the turn of the 20th century. The year is 1907, and America is in the grip of financial panic. Banks are failing, trust companies are collapsing, and the entire financial system teeters on the edge of oblivion. In steps a man named John Pierpont Morgan, J.P. Morgan, as history knows him. Picture the scene. October 1907, New York City. Morgan, then 70 years old and battling a severe head cold, summons the heads of major financial institutions to his library on Madison Avenue. The stock market had plunged nearly 50% from its peak the previous year. Trust companies were collapsing under the weight of bank runs. The entire American financial system was on the brink of collapse. Morgan locks these financial titans in his library and refuses to let them leave until they commit their resources to save the system. This is your problem, he tells them. You must solve it. For 3 days, Morgan orchestrates a rescue, pledging his own fortune and convincing others to do the same. He determines which institutions would be saved and which would be allowed to fail. As one historian put it, he essentially acted as a one-man Federal Reserve. This event revealed something profound about America. The most powerful nation on earth had no central bank, no lender of last resort, no government entity capable of preventing financial collapse. The fate of the American economy rested in the hands of a single aging banker. The 1907 crisis led directly to the creation of the Federal Reserve in 1913, establishing our modern banking system. But here's where our story takes an interesting turn. The Federal Reserve wasn't primarily created by elected officials or public servants. It was designed largely by bankers themselves, led by Senator Nelson Aldrich, whose daughter was married to John D. Rockefeller Jr., and who worked closely with representatives of J.P. Morgan and other powerful financial interests. In November 1910, Aldrich and executives representing the banks of J.P. Morgan, Rockefeller, and other financial powerhouses secretly met at Jekyll Island, Georgia, to draft what would become the Federal Reserve Act. This wasn't conspiracy theory. This was acknowledged fact. As Frank Vanderlip, then president of National City Bank, now Citibank, and a participant in the meeting, later wrote, "Despite my views about the value to society of greater publicity for the affairs of corporations, there was an occasion, near the close of 1910, when I was as secretive, indeed as furtive as any conspirator. The banking system that emerged wasn't designed primarily to serve the public interest, but to stabilize a financial system that worked for those who understood its mechanisms. It was, in essence, the institutionalization of a wealth transfer system that had previously operated in a more chaotic fashion. So how does this glitch in the matrix actually function? How does the stock market act as a wealth transfer mechanism? At its core, the stock market is remarkably simple. It's a venue where ownership in companies can be bought and sold. But unlike most venues where things are bought and sold, like your local farmer's market or retail store, the stock market operates on principles that would seem bizarre in any other context. Think about it. When was the last time you walked into a grocery store and found the price of apples changing by the second? When was the last time you saw people frantically buying hammers at Home Depot because they heard the price might go up tomorrow? That would seem absurd. Yet in the stock market, we accept this as normal. The stock market doesn't just facilitate transactions. It's designed to create advantages for those who understand its psychology and mechanics. And historically, we can trace specific developments that amplified this glitch in the system. The first was the separation of ownership from management. When stocks were first invented, they represented actual ownership in businesses where the owners were typically also the operators. But as public markets developed, ownership became increasingly distant from operations. Today, most shareholders have no operational involvement with the companies they own. The second was the development of increasingly complex financial instruments. In the early days, you simply bought shares in a company. Today we have options, futures, swaps, derivatives of derivatives, tools that create leverage and amplify both gains and losses. The third was the introduction of high-frequency trading and colocation, where the fastest computers, placed physically closer to exchange servers, can execute trades milliseconds before others, just enough time to profit from information the broader market hasn't yet processed. Recent data from the Federal Reserve shows just how effective this system has been at transferring wealth. As of 2023, the top 10% of Americans by wealth owned approximately 87% of all stocks, while the bottom 50% owned just 1%. The stock market, for all practical purposes, exists primarily as a playground for the already wealthy. What makes this glitch in the matrix particularly effective is how it exploits human psychology. The market breathes, it expands with greed and contracts with fear, creating discrepancies between price and value that the disciplined mind can exploit. Fear and greed. These primal emotions drive market movements far more than rational analysis. When prices fall sharply, our evolutionary programming interprets this as danger. Our instinct is to flee, to sell at precisely the wrong moment. When others are getting rich, our social programming drives us to join in, often at the peak. Consider the dot-com bubble of the late 1990s. By 1999, internet stocks with no earnings were commanding astronomical valuations. Stories abounded of everyday people becoming millionaires overnight. Fear of missing out drove more money into these stocks, pushing prices even higher. When the bubble finally burst in 2000, those who entered late, often ordinary investors who had been convinced to jump in, saw their wealth evaporate, while those who understood the pattern had already exited. Or look at the housing bubble of the mid-2000s. As home prices soared, financial institutions developed increasingly complex mortgage products to keep the party going. When it all collapsed in 2008, millions of Americans lost their homes, while the largest financial institutions received government bailouts. The aftermath? The share of wealth held by the top 1% actually increased after the Great Recession. This pattern repeats because it's baked into the system. The glitch isn't a bug, it's a feature. But here's where our story takes a turn. What if I told you that understanding this glitch could actually work to your advantage? That recognizing the matrix for what it is gives you the power to navigate it more effectively. The stock market may be a wealth transfer system, but the direction of that transfer isn't predetermined. By understanding the psychological patterns that drive market movements, you can position yourself to be on the receiving end rather than the giving end of these transfers. Think about it. If the market is driven by fear and greed, then maintaining emotional discipline gives you an immediate advantage. When others are panicking, you can assess situations objectively. When others are euphoric, you can remain cautious. Warren Buffett, perhaps the most successful investor of all time, famously advised, "Be fearful when others are greedy, and greedy when others are fearful." This isn't just clever wordplay. It's a recognition of how the wealth transfer mechanism works. During the 2008 financial crisis, while most investors were fleeing the market in terror, Buffett was investing billions in companies like Goldman Sachs and General Electric. He understood that the fear gripping the market had driven prices far below reasonable value. By 2010, these investments had generated billions in profit. The key insight is this: wealth transfers happen at the extremes of market psychology. During periods of maximum fear, quality assets get transferred from weak hands to strong hands at bargain prices. During periods of maximum greed, overvalued assets get transferred from strong hands to weak hands at premium prices. By developing emotional discipline and understanding these patterns, you can position yourself accordingly. This doesn't require predicting the future or timing the market perfectly. It simply requires recognizing where we are in the cycle of fear and greed and acting contrary to the prevailing emotion. This brings us to the ultimate truth about the stock market as a glitch in the matrix. It's neutral. Like any system, it can be used by those who understand it to transfer wealth in either direction. The distinguishing factor is knowledge, not just of technical indicators or fundamental analysis, but of the underlying psychology that drives market movements. By understanding how fear and greed distort price discovery, by recognizing the patterns that repeat across market cycles, you gain an edge that most participants lack. Think about it this way. The stock market is just numbers on a screen. These numbers have no intrinsic value. They're simply the current price at which transactions occur. But these transactions have real consequences. They allow you to convert electronic digits into real-world goods and services. They let you transform time spent working into freedom to pursue your passions. As John D. Rockefeller supposedly said, the way to make money is to buy when blood is running in the streets. He understood that market extremes create asymmetric opportunities, moments when potential reward far outweighs risk. This isn't about taking advantage of others. It's about understanding the system well enough to avoid being taken advantage of yourself. It's about recognizing that markets move in cycles, and that positioning yourself correctly within these cycles is the key to building and preserving wealth. The glitch in the matrix, the stock market's capacity to transfer wealth, doesn't care which direction that wealth flows. It simply facilitates the transfer from those who don't understand the system to those who do. With this understanding comes responsibility. If the stock market is indeed a wealth transfer mechanism, then your participation in it should be guided by principles beyond mere profit. Consider how you might use this knowledge not just to benefit yourself, but to create positive impact. Perhaps by investing in companies that align with your values. Perhaps by using your financial success to support causes you believe in. Perhaps by sharing your knowledge with others so they too can navigate the system more effectively. The Matrix, our financial system, was designed by humans and can be redesigned by humans. By understanding it clearly, without illusion, we take the first step toward making it work better for everyone. Before we conclude, I want to invite you to join our community where we discuss these financial realities and strategies in depth. In our Discord, we share resources and insights about market psychology, timing, and positioning that can help you be on the right side of these wealth transfers. The link is in the description below. Remember, the real glitch in the matrix isn't the stock market itself. It's the gap between those who understand how it works and those who don't. By closing that gap, you transform what could be a vulnerability into an edge. The choice is yours. Remain unaware of how the system functions, or understand it and use that understanding to your advantage. The matrix is there either way. The only question is whether you'll be the one exploiting the glitch or the one being exploited by it.